Are you thinking about selling your primary home or a rental home and you're wondering how will I be taxed? In this episode, we go through all the details.
We hope you've been enjoying all the episodes from the Secure Your Retirement podcast. If you'd like to keep learning and receiving these episodes, then hit the subscribe button and turn on notifications by hitting the bell so you receive alerts when each episode comes out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement podcast. And we are excited, as we've had now for the last couple of weeks, had Taylor Wolverton on our podcast. So I'll say welcome back for the third time in a row, Taylor.
Thank you.
We're talking a lot about taxes here in a few episodes, and what I know is that in my conversations with people, people realize that taxes and how it affects them and those different aspects of life can be one of the most expensive parts of their retirement plan. So we've are tackling some big topics right now, but what we wanted to talk about today that you put together some ideas on, because we have this happen very regularly in our practice, which is somebody sells a home. Now, there's two different types of scenarios that we're going to talk about. One of those is somebody sells a primary home, and then the other one is going to be somebody sells a rental property. Very different. And there are some benefits of having a home that's my primary home, and we're going to kind of walk through those scenarios. So again, a person could be selling their primary home and moving into another home. They could be downsizing. They could be multiple scenarios that could come about. But let's talk about this idea of selling their primary home. And if you don't mind, just make sure that we understand when we say primary, like what that even means, just so everybody's real clear in their head.
Yes. Okay. Let's say that first. So, your primary home there's kind of two tests that the IRS lays out. Obviously, you have to be the owner of the home, and you have to have used this as your main residence for at least 2 of the last 5 years prior to when you sell it. So that's kind of how the IRS defines primary home. If you're living in it, you own it, you've been there for at least 2 years. It doesn't even have to be consecutive years, but from the last 5 years, total of 2 years of living in it, there you go. Now it's your primary home.
All right, excellent. So now let's just so people can understand, because sometimes, people are used to what we would call a capital gain.
Yeah.
And a capital gain, for reference, is somebody owns a property or they own a stock or something like that for at least 1 year. And people think, oh, it's a long-term capital gain. But let's talk about this in the context of a primary home. And maybe if you could kind of walk us through an example so we could maybe talk about how does the gain on that home get valued or let's say counted toward me for tax purposes.
Yeah, so if we use an example, let's say you are selling your primary home, which you originally bought for $300,000. Upon sale, let's say your closing costs are $30,000. Closing costs also are part of the calculation when determining how much of your taxable or how much of your gain you will pay tax on. So that is an important note there. Another element is the improvements that you've made to your primary home as you have lived in it over time. We refer to those as capital improvements. We can talk a little bit more in detail a bit later of what qualifies as a capital improvement and some examples there. But let's say you put in $70,000 of capital improvements that during the time that you've lived in the home, and now you're going to sell the home for $1 million. So you originally bought it for 300,000. Let's say 30 years have passed. Now you're selling it for $1 million. So you've definitely lived there. You've met the tests for it being your primary home. And now the question is, how much tax am I going to have to pay on this sale? Obviously, there's been significant appreciation over the 30 years that you've owned and lived in the home. So that's kind of what we want to dive into and talk about in more detail.
All right, excellent. So at this point, if I had let's say the same thing with, let's say, a stock or something like that, I'm going to owe tax on all of the gain off of that original investment of the 300,000. Now I'll sell it for $1 million. So now I owe tax on a 700,000.
Right.
So what's different here, and how does what what does the IRS code provide for us when it comes to this primary home?
Yeah, so the benefit when it comes to your primary home, these rules are specific and unique to the primary home. The IRS allows you to exclude a certain amount of the gain upon the sale of your home. The amount depends on your filing status. So if you're filing single, your exclusion is $250,000. And if you're married filing jointly, your exclusion is $500,000. So in our example, if we go back to, the original purchase was $300,000, the closing costs and the capital improvements get added to our original purchase price to be what's called the basis. So $300,000 plus $30,000 in closing costs and $70,000 in capital improvements. That's $100,000 more. So our adjusted basis, the starting point is going to be $400,000. Now, if we go back to the sale of $1 million minus our adjusted basis of $400,000, we're talking about a $600,000 capital gain. The exclusion, let's say in this example, you're married filing jointly, so we're going to use $500,000 as the exclusion. $500,000 of the capital gain is completely tax-free to you. So our $600,000 gain minus our $500,000 exclusion leaves $100,000. That is going to be a taxable capital gain. The $100,000 is what will show up on your tax return and that you will pay tax on according to the capital gains rates that apply to you.
All right. So that sounds like a pretty good deal. Now, sometimes and we just kind of just on this point, is there any requirement that I go buy another house with that money in order to get that exclusion?
No, the exclusion is free and clear just by selling the home and having it be your primary home and having that tax filing status. Those are really the only qualifications. There are no requirements as far as what you go do with the proceeds or anything like that at all to qualify.
All right. So very nice benefit. So let's talk about a couple different scenarios here. There is a thing where we could have a partial exclusion. Could you kind of give us a
Yeah.
reason why we might have a partial exclusion?
Yeah, so there may be some circumstances where you don't apply or you don't qualify for the entire $500,000 or $250,000 exclusion. There could be things like if you had to sell your home sooner than the 2-year requirement after living there because your workplace changed location, or maybe there was a health issue for you or a family member living in the home, or maybe there was like a natural disaster that destroyed a part of your home and made it so that you had to move out, or unemployment, things like that, kind of unforeseen circumstances. The IRS does allow you to at least use a partial exclusion when you sell your home under that type of event.
All right, excellent. Now, let's say that we have another scenario, obviously not one that we want to overthink about, but it can happen. Let's say that I am married, which gives me that big $500,000 exclusion, but I now am in a scenario where my spouse passed away, and so now I'm selling my home for whatever that I, decide that I want to go live somewhere else for that reason.
Mhm.
What do I need to know about in that case? Because am I going to lose my big 500,000 and be knocked down to the 250, or how does that work?
Yes, that can definitely be a concern. Have seen that happen, unfortunately. A spouse passes away, now you're in this giant empty house alone, and you want to do something different with your life and your living situation. So, fortunately, the rule is that you have 2 years to apply the $500,000 exclusion after your spouse passes away. You're not immediately knocked down to the $250,000 when you start filing single after your spouse does pass away. There are also some changes to how the basis of your home is viewed when your spouse passes away. A portion of that steps up, we say your basis increases. So depending on your situation and what your purchase price was and what the value was when your spouse passed away, there are some benefits to you as far as the taxable amount when you sell after a spouse does pass away. Yeah.
Okay. All right. So now let's shift back because you talked about adjusting our basis based on improvements in the home. And
Yeah.
there's some things around what's actually considered an improvement versus just maintaining the home. So could
Yeah.
you kind of walk us through maybe what a person would think about as far as, because I mean, this is important in the context that if I'm making home improvements, I want to make sure that I keep that in mind as I'm doing it, one, and then
Yes.
two, maybe keeping some kind of documentation around that. So could you kind of talk about what kinds of things would count toward basis or improvements?
Yeah, so capital improvements defined as something that adds value, extends the life, or adapts your home to new uses. So this could be like a remodel of a kitchen or a bathroom, adding onto your home, getting a new roof, replacing the HVAC system, adding a water softener, even landscaping things outside if you put in a swimming pool, things like that that significantly change your home and add to the value of your home as you have been living there are considered a capital improvement. And yes, it is important to keep track of those capital improvements over time and save receipts when you add those purchases and have kind of a list of what those things are, because capital improvements will reduce the amount of tax that you pay when you do sell the home. So you want to have a list of those for future reference that you can come back to make sure you're getting the benefit of adding those to your home while you have lived there.
Hey, by the way,
Some of the,
is there?
yeah, go ahead.
I was just gonna say, is there do you have to report this on your tax return when you sell a home? Is that reportable and you breaking all that down?
Yeah, so typically you'll just do like one total value. You'll send your tax preparer, here's the total from my kitchen remodel that I did. Here's the total because we replaced the roof in this year, whatever, listing out all of your capital improvements, and then they'll add together that total, report it on your tax return. That'll be added to your basis, which the consequence of that is reducing the amount of taxable gain that you report.
Okay, excellent. I'm sorry if I
Yeah.
cut you off there. Was there
No, no,
anything
you're good.
else on basis?
I was just gonna say too, it is important to keep track of those things because a lot of figures that the IRS has and like exclusion amounts and contribution amounts are indexed for inflation, but this exclusion on the primary home has never been adjusted for inflation at all. Since it was introduced, it's been $500,000 exclusion for married filing jointly, $250,000 for single forever. So it would be nice. I would love to see it adjust for inflation to keep up with the home prices increasing, but that has not been the case. So it is something that's just important to keep track of too, because that is not going to adjust. And then on capital improvements too, things that don't count towards capital improvements are more minor things like fixing a leak or repairing a roof or patching a roof, replacing hardware, painting walls, things like that are not going to count as capital improvements. So you can still like keep track of them, and then your tax preparer can help you kind of determine which ones are capital and which ones are not. But yeah, just something else to keep in mind.
Okay, excellent. So let's go back to our example that we had and talk about now how we are getting to these, what those, how those numbers break down.
Yes. Okay. So let's say go back. Our original purchase price is $300,000. Closing costs we didn't talk about in too much detail, but again, things like the commission that you pay to your realtor and fees and legal fees that you pay when you close on the home and you're selling the home as the seller, the closing cost can be added to your basis. So $300,000 original purchase price plus $30,000 in closing costs. We said in our example, we have $70,000 of capital improvements. So now we're at an adjusted basis of $400,000. If we sell for $1 million, the difference there in the gain is $600,000. The exclusion in this example is going to be $500,000 under the tax filing status married filing jointly. So now we're left with $100,000 taxable capital gain.
Excellent. So now, just so we're clear, because we're going to talk about the rental here in a second.
Yeah.
I don't get to deduct anything as far as any kind of losses on my primary home. I got a big tax benefit on this
Yes.
this exclusion, but I don't get it, both things.
No, if you sell your home for a loss, let's say, you live there and for whatever reason the value goes down and you sell it for less than what you originally bought it for, you do not get to deduct the loss. So the
Okay,
same benefits don't apply if it goes the opposite direction and you are selling at a loss. This really only benefits you when you're selling at a gain. Yeah.
excellent. All right, let's transition now and talk about rental property. So, do I
Yeah.
get this nice exclusion and all these good benefits on my rentals?
No, unfortunately, the same rules do not apply to rental properties. There are other benefits that we will get into that do work for rental properties, but it's kind of why we wanted to talk about both of these in the same episode so we can have a direct comparison, primary home versus what to expect when you're selling a rental property.
Okay, so let's walk through an example so that people can understand the difference.
Okay, don't get too attached to the numbers. If you're like listening to this in the car, don't get too stressed out trying to remember all the numbers because there's going to be a lot going on.
And
If
I can
you
also
find
just speak
yourself,
on that too, and let everybody know that
yeah,
if you are listening to this and you're on a walk or in the car, you can also we have a blog written on this as well, and in the blog
yes,
article, it will have all these numbers broken down for you.
yes. If you find yourself in this situation, really, I think what's important to take away from this episode is just the concepts of the benefits that we're going to talk through. And then if you are going to sell your rental property, then you can call me and we can talk through the specific numbers that are going to affect you as an individual. But for our example, we're going to say, let's say you bought a rental property years and years ago for $137,500. Sounds like a weird number, but there is intention behind that. So, starting point, $137,500 purchase. The From a tax perspective, we have to split that value into the value of the land and the value of the building. Because what we're going to get at is depreciation. That's the benefit we're going to talk about for the rental property. And depreciation is basically the IRS saying your building is going to wear out over time because you're making it available to renters. There's going to be some wear and tear that happens with having renters occupy that building. So we're going to allow you to depreciate the value of the building, which gives you a tax benefit over time. And it's also kind of a way to incentivize investors to rent out their property and provide housing, and in theory supports the broader economy as well. So back to our starting point, we have to split up our original purchase price into the land and the building values. Usually you can look at like your property tax assessment, and on your property tax assessment, we'll say, here's the land piece, here's the building piece. It's not really something that you make up yourself. But let's say in our example, 80% of our purchase price represents the building. So that's $110,000, a little more of a round number there. And the other $27,500 is going to represent the value of the land. So to start depreciation, what is going to happen on a residential property, you can depreciate the value of the building itself. Again, not the land. Land does not depreciate only, but the building does. We're going to spread that value out over 27 and a half years. That's just a figure that the IRS provides. That's the rule, 27 and a half years. So if we take $110,000, which again is our value on the building itself, and spread that out over 27 and a half years, that is our depreciation that we can report on our tax return. So that's $4,000 of depreciation. It's kind of like an expense. So when you have your tax return, you list all of your rental income, you subtract out all of your expenses, your property tax and your repairs and your maintenance and your homeowners insurance. All of that stuff gets subtracted out from your rental income. And now we're going to add in $4,000 of depreciation. It's not really an expense, but again, it's just a way to represent there's some wear and tear on this building. So I'm going to say there's $4,000 of quote unquote expenses to get that tax benefit. So that reduces the amount of rental income you actually have to pay tax on over time. That's the benefit.
All right, excellent. So now let's just walk and go forward and say, now I sell my home. So
Yes.
I depreciated that 110,000. I've owned it
Yep.
for a long time. So now
Yep.
I've hit zero. I sell my
Yeah.
home. Kind of walk me through the math.
Yes. Okay. Fast forward, let's say 27 and a half years plus has passed. You only get the depreciation for 27 and a half years. So if you own the home longer than that, your your depreciation is going to run out. So let's say in this example, our depreciation has run out because 27 and a half years has passed. So as far as the IRS tax reporting is concerned, your building itself is now worth zero because it's fully depreciated. We still have the land value, so that's going to be part of it. But then let's say we sell the property for $500,000. So at the sale price, $500,000, we're going to subtract out the original value, which right now, because the building is fully depreciated, is just the land of $27,500. So our gain starting point is $472,500. Again, the actual numbers don't really matter. It's more just the concept of what we're trying to get at here. So because we've gotten this depreciation benefit over time, but now we're selling our property at a gain, the IRS is kind of saying, hey, we gave you those deductions, you got that benefit, but now you just sold your property at a gain. We want some of that back. So what has to happen when you sell your rental property is what is called depreciation recapture. If you remember back, we depreciated $110,000 of the value on the building from the original purchase price. So when we sell the property, $110,000 needs to be reported as depreciation recapture and is now taxable to you. Depreciation recapture is reported as ordinary income, subject to ordinary income rates, up to a maximum of 25%. So really depreciation, if you eventually sell your property for a gain, which ideally that's how it goes, it's more of a tax deferral than a tax avoidance. You don't keep that depreciation benefit forever. You will pay tax on it later on down the line upon the sale. So the rest of the capital gain, I'll go back. We kind of split into two categories here: depreciation recapture and capital gain. So starting with the total gain, again, the sale price minus the value of the land, $472,500. $110,000 of that has to be recognized as depreciation recapture and taxed as ordinary income up to 25%. So the other $362,500 of that gain is what's going to be categorized as a true capital gain, subject to capital gains rates, which are more favorable than ordinary income. It's 15% or 20%, depending on your total income for that year. So I know it's kind of a lot to keep track of, but to kind of summarize those two outcomes, we had $110,000 of depreciation recapture, subject to ordinary income rates up to 25%, and then $362,500 is taxed as capital gain.
Mm.
Both of those elements will show up on your tax return. You will pay tax on both of those. The mistake that I see a lot of the time is someone just going, "Oh, I bought it for 500,000, or I bought it for what did we say originally? The
500. Oh no,
original
we bought it for 137.5.
137, and I sold it for 500. That entire difference is just going to be capital gain. I'll take
Right.
15% of that, pay that as my estimated tax payment, and I'm done."
Right.
Unfortunately, with rental properties, that's not the case. A lot of times we forget the depreciation recapture is subject to higher tax rates. And if you don't plan ahead for that and have an awareness of that ahead of time, it'll shock you on when you get your tax return back and have to pay
Right.
more than anticipated.
Yeah. Well, very good. Well, I'm going to say, yeah, this was a lot of numbers. I like the
Yeah.
idea of what you said into the concepts, and I will reiterate what you said. If you're listening to this and you're thinking, I got a scenario that I need to think through that's my specific situation, the easiest thing to do is to go to our website, which is pomwealth.net. go to the Contact Us page, fill out the form, and then we can get it set up so that Taylor could reach out to you and answer those questions. So thank you very much, Taylor, for walking us through this and helping us to think through the difference between buying or selling my primary home versus my rental home. So we appreciate it.
Yeah, of course.
If you would like to find more information about Peace of Mind Wealth Management, we invite you to visit our website at pomwealth.net. If you go to the contact page and contact us, we'll send you a free copy of our book, The Peace of Mind Pathway. It lays out our process from beginning to end. Please visit our website.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.